All right, Roundtable Trading Thursdays. We're going to take a look at Apple first. Remember, I've been talking about shorting this stock for quite some time now. In fact, if I go over to my notes, I think the first time we started mucking around with this, it was back in June. So about a month now that we've been tracking this symbol. Let me zoom back out. And I'll tell you the reasoning from the beginning. We saw Apple get to its all-time high over here in April, above 640. And then we started into this down move, couple of really volatile days. We had one day where you've got about a $30 price drop, followed the next day by a $30 price rise. That, my friends, is volatility. A slight gap up, but then the move down. Now we have this gap here, and a gap up is, in my playbook, buying. Right? Somebody had to buy in order for price to get up there. Someone also had to sell, by the way, but we'll leave that for another day. So in the background was all this stuff going on. All-time high, gap up, price moved down, broke through not only the low but filled the gap. All of that builds together to form a bearish picture. So once we have the bearish picture, then we start looking for the trades. See, this is where most retail traders absolutely go wrong. It's why you continue to get into bad trades. It's why you're continually frustrated by getting stopped out very quickly. And some guys say, oh, just be more patient. It's not about being more patient. That's a bunch of bull. It's about understanding the operation in the market. Look, when you buy, in order for you to make money, somebody else needs to be willing to buy at a higher price for you to make money. In other words, if you've bought Apple right here at $560, you need someone that's willing to sell to you at a higher price that covers all of your transaction costs. If you're liable for taxes, it has to cover that. Your operating expenses, all of that needs to be covered in order for you to turn a profit. Well, if no one's willing to buy at a higher price, guess what's going to happen to Apple's share price? It's going to go down. I'm just letting that sink in for a moment. You see, too often, retail traders buy, sell, get into the market for, Lord only knows what reason. My spleen was aching that day. My brother-in-law said to buy. CNBC's talking about it's a bull market. Apple announced really great earnings. Yeah, all that stuff is great. It's great that there's news and that people are talking about Apple. At the end of the day, if you go to your broker and push buy and no one's willing to sell, you're going to get a message, something to the effect of, no stock available, could not fill, order rejected. There are all sorts of different messages that you are going to get. If you're talking to your broker on the phone, he or she is going to say, you know what, we can't get your price. So at the end of the day, where you trade and your trade selection has got to be based on how the market works. There needs to be a willing buyer and a willing seller. If you buy, there needs to be a willing seller at a price high enough to cover all of your costs, all of your expenses, plus more. So it's not about, that there's some magic volume number. It's not about having some magic indicator to put on your chart. It's not like Elliott wave drives the market or, WD Gann has some sort of cosmic force. It's all a bunch of hooey. So after we've gotten that there are sellers back here in the market. Again, we get we come to the conclusion that there are sellers. Price gets to the all-time high, goes down, gaps up. Not only goes down, but goes down past the low and breaks the. Price covers the gap, closes the gap, and breaks through the low. At that point, our trade selection has to be based on areas where there are other prior sellers. So follow out the reasoning here. And this is how most professional firms think. If big money is coming in and they want to short Apple, or they simply want to sell an existing long position in Apple, and you're talking about, let's say, 1 million shares or more. And if you look, there are literally hundreds of millions of shares of Apple, I believe, available. I think the float in Apple is a couple of 100 million shares. I could be wrong there. But let's just say that these institutional buyers and these institutional firms are selling a big block of stock. When you are selling a block of stock like that, you can't just push the sell button like you do on Interactive Brokers, my friend. It just doesn't happen like that. And so you have to have some way of selling this big stock, or this big block of stock. Some of them do it through computers, some of them do it through people, some of them are literally calling people up on the phone and talking to them. There are a multitude of ways that big blocks actually get traded. Now, the effect of that on the chart is this up and down action. Okay, obviously, if I'm selling a block of stock, I want to sell it at the highest price possible. So it's a constant balance of looking at the marketplace and seeing how many people are willing to buy and selling enough stock to get the stock sold without telegraphing to the market that you've got 1 million shares. Look, if everybody knew that a big firm was selling 1 million shares, you know what they would do? They would sell as much as they could right now to drive price down. Why? Because at some point that firm is just going to start dumping stock on the market in order to get it done. If you've sold at a higher price, that works out for you. Let's step through it over here. Let's say that we're happy as a clam, we're buying, and all of a sudden we get wind that there's a big order to sell. So what do we start doing? We start shorting Apple. What that means is we sell Apple up here. We sell first, hoping to buy later. And then we find out that that firm needs to sell above this box. And again, we're just pretending here to make it simple. The real world, as always, is more complicated than this. But here's what happens. We all find out, hey, there's this big block they need to sell. They've got to sell above this box. Otherwise, they're just going to start dumping stock. Our job then is to get as many people to gang up on that firm to drive stock or drive price below there. Why? Because we want to see this. As soon as we see the market's just falling, there's tons of shares coming in to sell. Every time, like, here's what I mean. For example, in order to get 1 million shares done, what would happen is, like, every time a block of 50,000, like someone says, hey, I'm willing to buy 50,000, these guys, boom, they hit it. It goes away. Then they say, hey, you know what? I'm a seller at 70,000. These guys hit it again. Boom. That's what causes this drastic price move. It's not cosmic rays, for crying out loud. It's simply put, someone needs to sell and they're willing to sell at ever lower prices. Okay. That's one way that market structure, right, how this market actually looks, gets created. Now, of course, I'm not saying that, like, I have some sort of crystal ball and I know how the market operates every single time. It's not about that. This is about getting you into a consistently profitable trading mindset. So after all of this junk happens, and by the way, retail traders drive themselves nuts trying to predict highs, trying to predict gaps. It's a waste of time, because this is what gives professional traders the confidence in the future to start selling. Now, if you go back and review my videos, what I talked about was selling against some of these highs. Okay, so let's walk through that. Once the market starts to move up, right, it's going to make this high. Now, as this high is happening, there's no way to tell that it's a high. So how do we know? What we have to look for is that the market shows us a couple of things. Number one, we need to see that the market makes highs and lows. This junk in here are not, these are not good highs and lows. Why? Because they're just one day. We need to see like a 3-day reversal like this. We need to see it pretty, right? We need to see it obvious. Why? Because this is obviously sellers pushing the market down and then buyers coming back into the market. So once price comes down and then back up above this prior high, that's when we can say we have an area of potential sellers. As soon as price moves back down, that's when we can come back as an aggressive trader and sell somewhere in here. Why? Because we've confirmed that there are sellers in that area. Remember, whether you're buying or selling, you need other people to help you sell. You need other people to help you buy. Trade selection in this area here makes more sense than any other place, makes more sense than looking for MACD or stochastics or any of that other junk, because that's where the sellers have driven price down. Now, we also have no guarantee that there are sellers here in the future, which is why we use money management. Now, of course, Apple pushed above that. That's not a problem, right? I'm not, like, again, we're not looking for is to be right and say, oh, there are sellers there and price has to go down. That's retail trader thinking. Retail traders are looking to be right. They're looking for some magic place in the market where you know for sure that you're going to make money. Doesn't exist. And if you're, by the way, if you're looking for that, I'm not the guy to listen to, because I'm going to rain on your parade. Even better though, once we get stopped out, which we did here, go back and listen to my videos. What did I talk about? We have sellers here and we have sellers here. What that means is I don't have to sit there watching Apple every day until it gets back up here. So if you look a few days ago, what did I say? Look, Apple is back up into this area. It moved up. Sellers came in here. They came in again here. Look at that. We even have a gap. So then what are we waiting for? We're waiting either for price to come back up or break through that low. Beautiful, specific, easy to see trades. Here's what drives retail traders nuts is you've got to ignore Apple for weeks at a time. And what most retail traders think is, oh man, but Matt, look at this. I missed out on all that trading. This is the sucker's game. If you want to chase those kind of trades, you can. You're going to get stopped out more often for smaller amounts, but you're also going to spend more mental money, like the psychological money. In other words, it's hard to continue to get stopped out. It's hard to play that game for most people. So avoid all that. Let the market do all this junk. Let the market do all this junk. And then you come in once you've already got 1, 2, 3 more tests of the prior sellers. Here's the punchline. If after the market has come up to a price level once, twice, 3 times, and it goes back above there, you can be more sure that there are buyers, which means your stop is well founded and you should get out of a short position expecting the price to go down. So if you were in Apple, of course, you've got the gap down here. With a $600 stock, you can expect, these kind of big gaps here. You've got this move down of basically $30. So that's Apple. That's Trading Thursdays. We'll see you again next week.